Okay, Chapter 11. Chapter 11 is a continuation from Chapter 10 in that we had talked about there are 5 journals in which we're going to use in a partnership business. Again, to review from Chapter 10, we use the purchases journal, which was any kind of merchandise that we buy on account from another vendor. And again, we're going to mark up the price of that merchandise and then we're going to in turn sell it to another customer. So we are customers to our vendors. If you can remember that for right now, we're going to get into that in just a minute here. We also use the cash payments journal, which is anytime we make a payment with cash. We write a check for expenses, we write a check to pay back accounts payable, we buy supplies, etc. We pay cash. That's going to go in the cash payments journal. The general journal we use for any transaction that can't fit into the other 4 journals, in which Chapter 11 talks about the other 2 journals, which are our cash receipts journal. Anytime we receive cash from anywhere, anytime we receive cash from sales or from somebody that we sold merchandise on account to, we're going to put it in the cash receipts journal. And then also the sales journal, which we're going to talk about first, which whenever we make a sale, we're going to record that in the sales journal. And we want to record our sales immediately. So objective here, again, Chapter 11, sales, or our sales journal and our cash receipts journal is first off 11-1, which is on page 254. We're going to learn how to record sales on account using a sales journal. Okay. Basically, purchases and sales of merchandise, purchases of merchandise and sales of merchandise are the 2 major transactions of any merchandising business, which is what we're working on right now. So a majority of our transactions are going to be purchases that we purchase merchandise for, and then we're going to mark the price up and make sales of that merchandise to our customers. So those should be the majority of our transactions. We sell merchandise to customers, and the customers is a term that's used in the book here, and it's any person that buys our merchandise. However, when we buy merchandise from our vendors, we're actually their customers, and then we turn around, mark up the price, and then we have our customers so that we can make a profit. Something else is that sales tax must be added to all sales, and the rate depends on which state you live in. I believe Michigan, we're at a 6.5% or 7% sales tax rate. So in Michigan, whenever you buy merchandise, you go to Best Buy, you buy a CD, or you buy a new phone, or you buy anything that you buy that's not a food. Food is not taxable in Michigan. Everything else is taxable. So that's why even though it says $29.95, you might pay $34.50 because the sales tax has to be included. So we're in charge of that sales tax as a business, as a merchandising business. Sales tax is a liability in the account classification, and the account that is affected is the sales tax payable account. Okay, and we're going to talk about that here in a few minutes. Omni, the example we're using, uses a 6% sales tax rate. So remember that. And an example would be price of merchandise times 6%. So if we have get my calculator out here. If we sell something to a customer of ours for $29.95, well, they're not going to pay $29.95. They need to pay the $29.95 plus the sales tax. So we're going to take the $29.95 and we're going to multiply that by 6%. Times 0.06 or 6%, which is $1.80. Now, an easy way to do that would be to take your $29.95 and times that by 1.06, and it will add that to our original amount. So what they would be paying, and we always want to round up to the cents. You can't pay 74.7 cents. So the amount that the customer would be paying on a $29.95 purchase would be $31.75. Okay, so that is a 6% sales tax rate. Also, one last thing is that revenue, sales, needs to be recorded at the time of the sale and not necessarily when the cash is received. We're going to sell merchandise on account. We may not get that money from that customer for another month. However, we want to record the revenue of that sales immediately on that date that we made the sale, not when they actually pay us back. And that's an important thing to remember as we go through this chapter. Okay. So when we are sales of merchandise on account, well, first of all, let's take a look at the sales journal. Sales journal looks like this. You have the date column, the account debited, all right, sale number, which would be right here on your sales invoice. A post reference, again, once we post to the general ledger in the next chapter, we're going to come back and put the account number in this box right here to prove that we recorded it in the ledger. And one thing that I would recommend, and when we get to that point, is not doing it all at once. Break it up into like 5 dates or 10 dates and recording in your ledger so that when you make a mistake, you can find it quicker and a little bit easier. We have our accounts receivable debit, which is an asset. We have our sales credit, and we have our sales tax payable credit. Now, we have these special amount columns because in a sales journal, we're always going to record sales and credit. Just like the cash payments journal, where we had the cash credit over here, it was always going to be the second account affected was cash. Same thing here. The second account affected is sales. And if you remember, sales carries a normal credit balance. So we're increasing our sales. Okay, you can't really decrease your sales unless you have a return. And then we have our sales tax payable, which is at 6% on that sale. Okay, so you're going to have two different things here. You're going to have to do some math. Here's what a sales invoice looks like. So when you see Omni Import, so when someone buys merchandise from us on account, we're going to fill this form out. And we're going to put it, who do we sell it to? We're going to get their customer information. We probably have a customer number for them in our database so that we know, oh, customer 120 is the Children's Paradise. Invoice number 76, the date, the terms. Again, term is how long do they have to pay us back? Well, they have 30 days in order to pay us back. Here's our inventory number of our merchandise. They bought African masks and Russian nesting dolls, 25 of them, 30 of them. Unit price is the individual price of each unit for a total of $450 and $366. We get a subtotal of $816. Our sales tax, again, is $816 times 6%. We add those together. Here is our total sales for that transaction, $864.96. Sales clerk's initials, customer signature here, then it becomes a legal binding document. If they disagreed with you or say, oh, we didn't buy that, this would hold up in court. So, first transaction, sales on account. We sold merchandise on account to Children's Paradise in the amount of $816 plus the $48.96, which is this amount times 6%, our sales tax, for a total of $864.96. Sales invoice 76, and that's this invoice right here. The accounts affected, accounts receivable. Again, it's an asset. We're going to increase on the debit side our accounts receivable. Now, when they pay us back, we're going to credit the accounts receivable account to kind of indicate that they have, we've decreased what they owe us, basically, when they pay us back. Our sales is a revenue type of account. We're going to increase our sales on the credit side, and sales tax payable is a liability type of account, and it's also increased on the credit side. So you see here, assets, again, always assets carry a normal balance of an asset. Sales, a revenue account, always carries a normal balance of credit. And sales tax payable, which is a liability count, is going to carry a normal credit balance as well. All liabilities do. Here's how it's going to look in the sales journal. Again, unlike the general journal where we would have 2 accounts affected, we still do have 2 accounts affected. However, Since this is a special journal, we only need to record it onto one line. So we're going to include the date. We're going to put the customer's name here of the account we're debiting. Children's Paradise, sales invoice number 76. We're going to debit that asset, increase it, $864.96. The sales portion of this was only $816. They only purchased, the actual cost of the merchandise was only $816. We times this by 6% to get this amount, $48.96, which is our sales tax, which they pay. So these two amounts here equal this amount, right? So that it equals out the debit side and the credit side of that transaction. So very important to know that. These are all special column headings. There is no general debit, there's no general credit. So basically, when we sell anything on account, it's going to go in the sales journal. Accounts receivable is always going to be debited. Sales is always going to be credited. And we're always going to have a sales tax. Never not going to have sales tax. Basically, when you get to the end of the month or the end of the accounting period, we should have all of these. These are all of our accounts receivable accounts and what they bought from us. So here's our invoice number. They buy an account. Here's the total of what they paid us, or what they're going to pay us, I should say. They haven't paid us yet because this is an accounts receivable. They owe us at a later date. Here's the actual cost of the merchandise and the sales tax on each of those transactions. So these two amounts will equal this. These two amounts equal this. These two amounts equal this. This is the total sale. This is the actual cost of the merchandise plus the sales tax, which you're always going to have. At the end of the period, you're going to put totals. You're going to single rule, double rule this. Again, use the Excel feature of auto sum, and also use the borders to put your thick double border and your thick single border line here. When we get to the work together, which is on page 258, here's what that looks like. It says first of all, use page 9 of a sales journal. And again, your journals can be located on your class calendar page for this date. You have sold merchandise on account to Adrian Makowski for $800, plus the sales tax of $48 for a total of $848. So in these transactions, they're actually giving you this amount. They're not making you yet figure out the sales tax. So you see this plus your sales tax equals your total amount of what they owe you at a later time. Again, accounts receivable asset is you sold something on account. They owe you within your terms, whether that be 30 days, 3 months, a year, etc. We're going to single rule these transactions at the bottom, double rule these transactions at the bottom, and total them up using the auto sum feature in Microsoft Excel. Down here at the bottom, again, this isn't going to be on your sales journal that you download, but you want to make sure that this amount here equals this plus this. So your debits equal your credits. It's always going to be equal. And you see here down at the bottom, you should have that $3,323.10 on both sides, debits and credits. Okay. Terms to make sure that you know what a customer is. Again, we're a customer to our vendors, and who we sell to are our customers. Sales tax is dependent on which state you live in. For right now, Omni is a 6% sales tax, and a sales journal is what we record any sales on account that we might have. If you have more questions, again, please refer back to this video, watch it another time, or pause it, stop it, whatever you need to do, and also ask questions in class.